The European Central Bank cut interest rates this month, while in the US, the Federal Reserve is continuing to scale back its stimulus program. Confused? Mark Haefele from UBS Wealth Management is here to help us explain how investors might navigate that gulf between the two central banks. Mark, after everything the ECB did earlier this month, the euro seems to have been remarkably resilient. Why do you think that is?
Well, the euro's been strong in part because a lot of money has been flowing into the eurozone to buy these peripheral bonds. But now we've got 5-year bond yields lower than they are in the United States. So we don't think those flows are going to continue. Secondly, Mario Draghi is now just not talking about action. He's actually started to take some action. Third, we see the U.S. economy continuing to do better. People are over this kind of winter slump that was caused. They realize that strength is back in the U.S. economy. So all those factors lead us to believe the U.S. dollar is going to be stronger versus the euro.
So you think then the Eurozone bond rally could be running out of steam at some point soon?
It's come a heck of a long way, and we think that globally there's growth. So over the 6-month view, we see 10-year yields rising.
And here in the UK, the dynamic is different. The Bank of England has actually talked about raising interest rates. How does that affect your view on UK assets?
Well, the UK wins the World Cup for economic policy, getting out of the financial crisis. Started early with the QE, lowered interest rates, lowered government employment, lowered corporate taxes, and now you guys are reaping the benefits from that by having an economic recovery. So that's going to be, if rates get raised, that's going to continue the strength of the UK pound. Paradoxically, this has a little bit of an impact on, say, the FTSE 100 because a lot of the earnings come from outside of the UK, and so that pound strength can actually hurt the earnings on the FTSE 100.
If we look at markets as a whole this year, one theme that's attracted a lot of attention is the very low volatility. Some people see that as a sign of complacency. Is there any danger lurking out there in the lack of volatility?
Equities are an asset class that have a 15% volatility a year. And that's not going to change just because we have a period of low volatility. So people have to remember that that's going to return at some point. But there's a lot of factors that are contributing to these lower volatility, including the continued central bank asset buying around the globe. So while volatility is likely to return, particularly during the summer months, over our 6-month view, we still think that risk assets like equities in the United States and in Europe can perform well.
And in Europe, speaking of equities, we've seen a fairly strong performance already this year, but really in the absence of any meaningful earnings growth, how much longer can investors wait before some of that growth starts to come through?
Well, that strong euro that you talked about kind of hurt the earnings growth, but that's getting baked in now. So even if the euro were to stay at these levels, and again, we think it's going to fall, it's no longer going to continue to have the same impact on earnings. So we actually think you're going to start to see that earnings growth relatively soon.